All right, John Black, Chief Equity Strategist, Zacks. I'm up for the fundamental view. Today, I'm going to go through a lot of slides on why I think this current period, 2020, 2021, is a lot like this 1998 to 2001 period. And I'm going to show you some of the similarities and differences between these two periods. As is evident from Cathie Wood, the ARK Innovation ETF provider, and the Janus funds, if you remember those funds back in the 2000 period, the Janus 20 was this big fund buying tech stocks. That was a mutual fund. This time around, we have these ETFs, which are Cathie Wood's, and the most prominent one is ARK KK. There's also ARK Genomics. There's all kinds of other ones. She's been putting these out as long as people put money into her service. So lately, this has been tanking. I did this talk a month ago and said it was worried about tanking, and it has tanked further since that. So you will see some of my slides are 3 weeks old. I purposely did not update them because I'm not talking my book. I thought it was a bad play 3 weeks ago, and it's still a bad play. The point of this discussion is markets are jumping in front of fundamentals now. So they're prefacing the fundamentals. And this is why I'm talking first before we go through the slides. My fundamental view is, yes, the economy is getting overstimulated by trillions of dollars in the United States. Yes, the vaccination rates are improving. Yes, we get to 60% vaccination rate by July and coronavirus is gone. All of that is good, but the markets are priced all of that in, are looking beyond that. And this is why we have to worry about what's going on in the NASDAQ, which means what's going on with Cathie Wood, and all this stuff with the ARK funds has to be discussed. And that's what I'm going to do today. All right. So the first thing I want to talk about in terms of 99 through 2001 and now is the number of IPOs. Obviously, when the stock markets are up and valuations are high, it's a great time to initial public offer any type of company you have developed. So let's talk about how far this bubble has gone versus the last one. Last time we did about 1,000 companies over 2 years, 99 to 2000. Now we're about 400. So the first point to be made with the IPO slide is this is a 40% of the bubble last time. That's like the good news, that's bad news, because obviously this can carry on. And we can go back to that other period of time in the next year, or we can be done with this. And frankly, since we have this history of 99, 2000 in people's minds, maybe this one doesn't get as far out of control. So then the good news that's good news is this actually hasn't gotten as far out of control as the one before. It can change. We'll see what happens. All right, the SPAC frenzy, Special Purpose Acquisition Corporation. This is a new concept to apply in frothy times. Right, so you got a lot of people out there willing to put money to work without a lot of self-awareness about what's going on. So you go ahead and say, I'll just get the team together. You give me the money. I'll go pick up stuff for you. Basically private equity for public people. And again, this is blown up in late 2020. It's actually tanked in the last month or so. And again, this is like the Cathie Wood story. A lot of the frenzy seems to be off at the moment. So again, maybe that's the case, but again, this stuff is complete froth and kind of crazy to just hand money over to people who can buy it better for you. But basically, I guess you could argue some of these people actually do know more than you, and they can buy stuff that you cannot buy, and so maybe that's the part of it. But of course, this is going to get on the 20 firms that are SPAC right will go to 2,000 if you keep putting money into them, and that's always the problem and always the case. All right, so let's go back to 2099. Here is the top tech names in 99. Two names remain in play these days, Red Hat and Ariba. Red Hat got bought by IBM. That was the one single thing that really did work on this list. Ariba was this business-to-business thing that is bought by SAP for $4.3 billion back in 2012, which was the IPO price back in 99. So Ariba, as one of the successes, was not really a success. The truth about this whole list is only Red Hat worked. One of the things you can learn for today in this market is the thing that separates all these others from Red Hat is Red Hat was a bona fide product. It was an operating system. These other things were these concepts of business concepts. Now, I pulled one up just to show you. Vertical Net's the third one on the list. Vertical went from $8 a share to $164 a share. here's the story of VerticalNet. It was a host of 43 business-to-business portals based in Horsham, Pennsylvania. Market cap of $10.9 billion in March 2000. And it was acquired by Bravo Solutions 8 years later for $15 million. So again, the thing to worry about here is business concepts versus products. So business to business was the big idea. Business were getting in front of the internet. Consumers weren't going to catch up as fast. And this was the idea. And of course, we know that Amazon actually was the play business to consumer. And it took a long time for Amazon to work. All these business to business things didn't work because firms did them themselves. And it wasn't a standalone business product. And it's a business model. Obviously, it can be any ways, any existing firms can go ahead and do this. So business models should be your worry today. Now, who to point out that's problematic? FinTech, right? FinTech, big nerd. Business banking is going to go away. Again, Square is a given product and works fine. It probably will continue. It's like a bread hat. But this stuff about, SoFi, where, SoFi is going to take over JP Morgan Chase, I don't think so. It's another vertical net. You got to worry about it. So my point of looking at this piece is that's the lesson. Look for products, not just stuff. Now today here, this is this post-SPAC mergers, guys that really kick butt. And again, this is a crazy one here, QuantumScape. QuantumScape is the real big spiky one that went up 750%. It was actually up 1,200% at one point. Now it's down a bunch. What happened with QuantumScape? This is a Bill Gates endorsed and Volkswagen endorsed electric battery maker in Silicon Valley with just researching a battery. It doesn't have a battery. It is researching a battery. So you're investing because Bill Gates invested and Volkswagen invested, but you're not investing in a product. So again, it really may work. But again, it's not a product yet. And that is speculative. All right, now we get into the ARK-K funds. This is the story of the story, and this shows you the S&P or the Invesco Midcap 400 Pure Growth. So this is a better thing than the S&P benchmark is midcap growth stocks, or what this could be or should have been. And you can see the big takeoff. Kathy Wood was outperforming for 5 years. She was doing a good job, but the big takeoff just took off. And these are non-profitable tech stocks, up 600%, 500% in the last year and a half. But now, as you can see, everybody's taking profits, and it's under distribution, what's called distribution. I mean, people are taking money out of our KK. So the retail people are pouring into this thing. People are pouring out of this thing. This is what you should be concerned about. If you own a stock and a tech stock and it's an RKK, it's going to do whatever Kathy Wood does. So make sure you understand if you want a tech stock, if it's in RKK, you got issues. So let's take a look at what she's got in here. She has innovation, genomics, next-gen internet, fintech, autonomous tech, and robotics as her ETFs. Now, again, back to the 99 period, we can talk about what's better than not. Again, it's just basically what's a product and what's not. And don't get confused about researching a product versus an actual product. That would be the list here. These are her ETFs, various sizes. Obviously, some of them are really big. The ARK-KK at this point in time, and this slide was made, it was 24 billion. Our genomics was 10 billion. Next generation internet was 8, and so on. So she'll put up as many of these funds as you want to put money into it. All right, there you go. So you can see that there was huge inflows of capital that drove up the bubble last year. Now that's over. And that's what you should be concerned about. Year to date, to April 19th, they were down 3%. Well, you could have just made money in S&P and stayed out of this stuff. So here is all the little things that she's buying. All right. Do you know what they do? And do you know how to find out? Again, people, don't be lazy on this stuff. You can Google these names and just go find out. I mean, it doesn't have to be prospectus. Just go find out. And if you can't find out, why should you be buying? I mean, do some homework, be diligent, and stay on top of this stuff. She is not a genius. She is getting way too much exposure at the current point in time. So here's the S&P and here's the NASDAQ going back through this period of time. And again, no question that the NASDAQ is doing much better than the S&P 500. However, you can see that big pullback that is consistent with ARK-KK's pullback. and then it recovers. So you can see that NASDAQ a lot more volatile right now, and it's topping before the S&P. There's obviously people in the fundamental view are still believing in industrials, believing in commodities, but they're not actually believing in tech stocks anymore as much as they used to last year. So that's a part of my fundamental view. So I'll finish up with the 99 story versus the 2000 story. Here's the slides, returns of the Dow, the S&P, and the NASDAQ. First column is the Dow, the second is the S&P, and the third is the NASDAQ. And then you can see there was these two incredible years where the NASDAQ just really killed it. But the other years, actually, the NASDAQ wasn't any much better than the S&P or the Dow. So let's look at now. Obviously, last year, the S&P did 16%, while the NASDAQ did 43%. The year before, 35 and 28%. So again, same thing we've learned before is that this is only a year-long thing. Not quite as aggressive, but half as aggressive. And it's somewhat staggering around. So obviously, I don't want to tell you what's going to happen. We're all out there watching this, but there's two cases. One is the case that it continues for another year like 2000. The other is people learn from the past and they're starting to take profits out of this stuff and they're moving on. So that'll be my fundamental view, kind of an agnostic one where we have two cases. And I just point out, understand the RKK dynamics behind the NASDAQ, understand the stocks in it, understand this lady's role. And that is a key piece of what's going on.
Hey folks, Dave Bartosiak here, and I've got our technical outlook for the month, or at least just where the technicals are right now to give you an idea of what this market is going through. So let's go ahead and hit the charts. First, I'm going to take a look at the Dow Jones Industrial Average. The darling of the market has definitely been the Dow Jones Industrial Average. And now everybody's sort of using this post-COVID low or COVID low as a reference point, on the Dow Jones Industrial Average. You're talking 18,000 and change. Well, look at where we are. We've nearly doubled off of that. 35,000 on the Dow today, another all-time high. And that's sort of what we just keep seeing is again and again and again, we print these all-time highs. Every single day, there's another one. Boom, 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 boom. Now, not complaining at all. All-time highs are great. And look at how we got here, really. A little bit of nerves for the market towards the end of last year as the Dow Jones Industrial Average fought through the 200-day moving average, came back down to test it, bounced a little bit, test it, bounced a little bit, and then it finally broke through in about November of last year. Since then, it's interacted with this 50-day on a couple occasions, but for the most part, has really remained bid. Now, why is that happening? Well, there's a little bit of a rotation taking place in the market. What I mean by that, let's take a look at the S&P 500, okay? Again, this is another sort of broad-based index. You see a similar situation where we were bottoming out in the fall. In this case, came under that 50-day moving average, found a bit of a bid, and then again, finding support there just a few months ago, and now back to all-time highs, right? That's more of a broad approach. But if we zoom in now here on the NASDAQ composite, here's when things get a little bit different. The NASDAQ getting a little top heavy here. Now, by no means am I calling a top in the NASDAQ, so I don't want, before the pitchforks come out on me, that's not what I'm saying. All I'm saying is this is a double top right now that has knocked the NASDAQ down, okay? Now, the good news for the bulls is that the dips underneath that 50-day have been bought, and they've been plenty. Happened in the fall when the Dow and the S&P were struggling as well. Happened earlier this year. And now we're right there at that 50-day moving average. Now this 50-day moving average happens to have basically a zero slope. So it's horizontal. What does this mean? Well, the NASDAQ is range bound right now, which you didn't need that 50-day moving average to tell you, right? You can just kind of look at it and say, okay, well, we're bouncing around in a range. Now, should this 50-day break, you're going to get support at the 200-day, which right now is at 12,425 rather, on the NASDAQ composite. So a little bit of a ways down when we're talking, we're at 13.5 right now, but wouldn't be the end of the world to see a retracement down to here. There's been that sort of rotation like I've been talking about before. We're seeing commodity prices on the move higher, and then maybe these the tech stocks just got a little bit too extended. Now, another thing that the market was worried about that all of a sudden we're not worried about anymore is the 10-year Treasury note yield. Okay, so yields came off of lows close to 50 bips. Well, I mean, you have the post-COVID low, really got down there, but when you look at last summer, 50 bips was kind of where the 10-year was, and then you have this big move up almost to 1.8%. We were really getting worried about this to start the year, and all of a sudden, over the last 6 weeks or so, this trend has begun to reverse again, and we're starting to see yields tick on back down. Now, yesterday got under 1.5%, and if you think in terms of what Treasury yields are, they're supposed to be inflationary expectations, in this case, over the course of the next 10 years. So that's supposed to be reflected in that. So obviously, when we start to see some inflation, that's when you get the uptick in these rates as expectations change. So I think what this is just telling you is there's a healthier landscape out there for inflation and the way that the market views inflation. And right now, the market is doing a little bit of adjusting. There's been some rotation away from the tech stocks and into the more traditional Dow Jones Industrial Average type stocks. So there you have it. That's my technical outlook on the market right now. Enjoy the rest of the show.
John Blank and Dave Bartosiak agree to disagree right after this list of recent Zacks Ultimate Top Movers.
All right, John Blank here, Chief Equity Strategist Zacks. Dave Bartosiak and I today are going to talk about Bitcoin. Obviously, he runs the Bitcoin trading service, so he will be pro-Bitcoin. I am not pro-Bitcoin, and I'm going to give you my understanding of why I am not pro-Bitcoin. Now, first thing to understand about Bitcoin is Bitcoin and is backed by blockchain. Blockchain is a little older thing. It started in 2011, 2012. Bitcoin is a little bit newer. The guy to understand that founded this whole thing is a guy named Satoshi Nakamoto. Now, Satoshi Nakamoto owns 1.1 million of these coins. So 21 million are out there. 1.1 million are owned by this guy, Satoshi Nakamoto. Now, at any time, Satoshi Nakamoto can just sell as a million coins. So you got a hangover in this market, or this crazy guy who founded it can knock you out. So let's go through the top 10 holders of Bitcoin. Number one, of course, is Mr. Nakamoto, who's worth something over the tens of billions now. So no incentive there for that guy to unload those currencies. Number two, Bulgaria. Bulgaria is now owner of 220,000 Bitcoins as of May 2017 because of the amount of crackdowns on organized crime that they have done in the Bulgarian system. According to Bulgarian authorities, these criminals use their technology to avoid taxation. So this is a big play in Bitcoin, is to avoid taxation. A lot of Chinese owners of Bitcoin because they want to get it out of the government. So number two is I do think Bitcoin's going to be around for a while because people in China do not trust their government. However, remember, Satoshi is in Japan, and the Binance, which is the biggest thing, that's his thing, is what basically is mined by Chinese mining. So again, let's think about this. We got a Japanese owner and Chinese mines and a lot of Chinese investors sticking Bitcoin up. Great. That's not unstable, is it? And now we know the number two place is the Bulgarian authorities who have confiscated 220,000 coins. Number three, Bitfinance has 163,000 coins. This is what's called a Bitcoin wallet. It's a cold wallet, they call it, to protect it from cyber attacks. Okay, that's great. So now the number 3 holder is there to protect you from cyber attacks. Great. I didn't know that cyber attacks could take Bitcoin out, but they can. Now, number 4, for all you guys out there that really think this is great, the 4th largest holder of Bitcoin is the FBI. They, in September 20, they took over Silk Road. If you remember that, they confiscated 144,000 Bitcoins off of Silk Road, and they made a fortune. The FBI made a fortune on Bitcoin. Most of those coins they sold to this guy, Barry Siebert. Number 5, the Winklevoss twins. Remember those guys with Facebook? They own several. Let's see what we got here. They've got, they bought 1.5 million Bitcoins. So they got this guy. Then there's this guy, Gavin Andreessen, who's Satoshi's buddy, who sort of founded this thing. Roger Ver and this Barry Siebert, Charlie Shrem, Tony Galippi. Doesn't this sound like mafia stuff? So it sounds like a Ponzi scheme to me. I think you're going to be mistaken for believing in this, but I do think it's got real value for all the crooks, tax avoiders, people who don't trust communist governments. And I do think it's going to stick around. And I think we've been right to have the service for this period. But it's a trading service, not an investing service. And this thing can and will blow up. That's all I have to say. I'll let Dave Bartosiak give you their side of the story. Thanks.
I love everything the good Dr. John Blank has to say when it comes to economic discussions like this, because after all, the guy knows his stuff. So I'm not going to argue on economics or anything like that. But the shot about the nefarious characters that are operating in the crypto space, yeah, well, I get it. Sure, in the early days of crypto, or even now, you could use some kind of cryptocurrency to buy something on the dark web that's illegal that you probably shouldn't have, okay? I get it. But last time I checked, there's plenty of people buying things in dark alleys in the cities using cash. Does that mean I should go out and have a war on cash and say that no one should have cash and it's only used for criminal activities and so on and so forth? No, I think the smear campaign against crypto has been pretty obvious. It's coming from places that stand to lose the most. So if you're a big bank, of course you're going to smear crypto. Think about the early days and how much garbage Jamie Dimon used to talk about crypto. How it was the worst thing on earth, how it was a scam. And I'm not quoting, I'm paraphrasing here, right? But we all know he used to hate crypto. Now all of a sudden, JP Morgan has a crypto trading desk. Oh, I guess it's okay as long as JP Morgan's going to make money on it, right? All of a sudden, these banks are finding ways to legitimize this and make money off of it. And it's not so criminal anymore. So here is the fact of the matter. The fact of the matter is that digital assets, digital currencies, non-fungible tokens, the list can go on and on about that whole world, that whole digital space is changing the way that money operates, changes the way that people send money back and forth. We're changing the set of values that we even have. It's a different world. I know it's going to be tough for some people to understand that when you've grown up in a completely different way, pre-internet, before this whole new way of communicating with people, before the digital exchange, all of that. I understand. It's going to be hard for those people to think about it. But now, imagine being a kid today and growing up in this era. It's going to be the opposite. You're going to feel like paper money is this dinosaur, and why would I use that when everything that I have is just digital and it can go from here to here in an instant? I remember the days when if I wanted to give money to somebody, I took a piece of paper, I wrote on it, it went to my bank, went to his bank, and this intermediary shook hands, and then money moved from one to the other, and it took a while. It didn't happen instantly. And if you wanted it to happen instantly, you had to pay up, and it still wouldn't be instantly, right? You want to send a wire today from one person to another, it's going to cost you $35. Sure. Now what happens in this new digital world? I click on my phone, boop, it's over there, right? But now there's a way that we can get rid of the intermediary that's sitting there taking a little bit of money. So the long and short of it is crypto's here to stay. Yes, there are scammy coins out there. Of course, that makes sense. maybe Bitcoin is not the be-all, end-all that people hope that it's going to be. But at the end of the day, what I know is crypto is here to stay. And if you don't like it, you're going to end up looking like an old man shaking his fist at the sky. That's my argument for crypto. We can agree or we can disagree. It's up to you.
Ahead of the Zacks mailbag, here's this list of recent Zacks Ultimate new additions.
Hi, I'm Kevin Matras, and this is the Zacks mailbag. So today I'm going to address something that I saw quite a bit of when people were submitting their questions, and that was, I'm seeing the Dow and the S&P make new highs, yet my portfolio has been going down. Why? Also, too, others voiced concern that the NASDAQ has not been keeping pace with the market's recent highs either. So these are both legitimate concerns, and personally, I think these two things kind of tie in together. So that's what we're going to be talking about today. So first, let me just say regarding the NASDAQ, it is true that the NASDAQ has been underperforming the Dow and the S&P. I mean, year to date, the NASDAQ is only up 5%, whereas the Dow is up 14 and the S&P is up 12. But let me also put it into the proper perspective, because if you were to look at last year, the NASDAQ outperformed both of those indexes. The NASDAQ was up 111%, the Dow was up 88, and the S&P was up 91. So the recent underperformance of the NASDAQ, that is a very recent phenomenon. But if you were to go back over a larger stretch of time, you can see that the NASDAQ has been a great performer. Now, that doesn't mean because the NASDAQ has outperformed in the past, it's always going to outperform, nor does it mean that since the NASDAQ is underperforming now, it's always going to underperform. But I just simply want to point out these two differences because it's important to put everything into the proper context. But anyways, regarding investors seeing the market go up while their portfolio is losing ground, I would say you want to really drill down into the individual stock level. So, when you're picking your stocks, obviously looking at a Zacks rank of a number 1 or a number 2, or companies with the best style scores, or companies in the best Zacks ranked industry, obviously those are going to be your best bets. And you always want to focus in on those types of things. But I would also tell you, don't overlook what your stock's beta is. Now, as you know, beta is a measure of how volatile your stock is in comparison to the market. In this case, we're talking about the S&P. And usually the beta coefficient is analyzed over a 5-year period. A beta of 1 means that your stock is as volatile, or at least it has been as volatile and is likely to be as volatile as the market. Whereas a beta of 0.5 means it's half as volatile, whereas a beta of 2 would be twice as volatile. And the higher the beta, the more volatile your stock has been in the past and is likely to be in the future. So having a high beta stock is fantastic when it's going up. But when your stock is, let's say, chopping around or it's pulling back, that can really, make you feel like you're missing out. You can see a great underperformance in your portfolio, especially when the market's going down. Your portfolio could look meaningfully different than the benchmarks you may be comparing it to. So I would recommend looking at your stock's beta and take a look at what your portfolio's beta is as well. If you're looking for ways to reduce your portfolio's beta or reduce your portfolio's volatility, you may want to consider reducing the position size in your highest beta stocks. Now, of course, if there is no reason to be in that high beta stock, getting out is one of the best things to do. But if you still like that stock, there's a reason to stay in, but the volatility is just a little bit too great for you. Consider reducing your position size in those high beta stocks. By the way, since we're talking about possibly reducing volatility, another thing I would say is you should take a look at your allocation. For me, I never want to have more than 20% allocation in any one sector or in any one industry. And of course, that goes without saying, I wouldn't want to have more than 20% into any one stock. Again, if in fact the market goes up and you do have this overweighting, good for you. But if the market goes down, that can really have a devastating impact on your portfolio. So make sure you are not overly weighted in any one area. And it's easy to get overweighted, especially when you're in a sector that's doing great. You find yourself accumulating more stocks in that sector, or you find your positions growing and growing. Be cognizant of how much you have into any one of those spaces and make sure it doesn't get out of hand. So keep all of those things in mind when you're building your portfolio and you're trying to figure out how you're doing in comparison to the overall market. Overall, though, I would say, look, the economy looks fantastic. The stock market looks like it has a lot more upside to go. So just figure out how to take full advantage of it and figure out how to minimize as many mistakes as you can possibly do. If there are things that you should be doing differently, be honest with yourself, figure out how you can, correct those mistakes, because we're talking about a market that really looks like, we could be in a beginning of a multi-year boom. So you want to figure out how to take full advantage of this. So keep those things in mind when you're building your portfolio.
Shiraz Mian and Dan Laboe are up with the portfolio makeover after these interesting insights from Zacks Ultimate Editors.
Hi, this is Shiraz Mian with another episode of the Portfolio Makeover segment. Thank you all so much for those amazing portfolio submissions that you always do. Joining me today will be Dan Laboe. Dan and I both have picked one portfolio each, and we have added that to the Zacks.com portfolio tracker. The portfolio I picked is from customer Wakid J, which I've added to Zacks.com. So let's go ahead and take a look at Wakid's portfolio. So as you can see here, I have the portfolio, Wakid's portfolio on Zacks.com, and this is 17 stocks. So typically, this would be a smaller portfolio relative to what I consider as optimal, which is in the low to mid 20s range. But there's still a lot of interesting elements in Wakid's portfolio that I wanted to share with all of you. Just beyond what you see on the screen with these 17 holdings, Wahid mentioned that he's a relatively new investor. And he mentioned that the Tesla position here accounts for about a fifth of his total position. And then the Twitter that he has, I don't think you can see Twitter here, but right here at the bottom, he got into this position after the company's somewhat disappointing results. So that's the additional information we have. And then the other information Wahid provided was that he's trying to build a long-term portfolio, and that's his effort right now on that front. And when I look at the holdings, given the information that he provided, I come away impressed, and I'll tell you why I am impressed. Even though there is only 17 stocks in this portfolio, Wahid has been able to add a significant amount of diversification. So we know how big Tesla is. There's a few others that are on the large side too, Twitter in particular. There is this NIO, which is the Chinese EV maker. He also has Alcoa, he has Axle, both kind of in the traditional area. He has 3 on the medical side, biopharmas, AXSM, I believe Evolus is also in that category, and so is GTBP. He has some technology. You could say he has finance. Coinbase is there. There is probably one other stock. But as you could see here, it's an aggressive, growth-oriented portfolio. So without knowing the particulars of Wahid's position in terms of his risk tolerance, in terms of how long he envisions holding on to these and when he expects this to pay off for him, I think he has the building blocks of a very good portfolio here with a good blend of traditional industrial material type of names, as you could see through Axle, through Alcoa, and I believe 1 or 2 other names, some healthcare, some EV, some crypto through the Coinbase, and also there is size diversification. So from the large tech players to a host of smaller players. Yes, so US Steel was the other traditional industrial material type of names that he holds. I would prefer if Wahid could have a little more cyclical exposure. So perhaps traditional finance beyond the fancier Coinbase type of stuff. So perhaps a bank, perhaps an insurer, though he has Lemonade, as you could see here, which would fall in that category. And then perhaps a little bit more of the traditional materials, industrial kind of exposure. But all in all, he's on to a pretty good start. So with that, I'll pass it on to my colleague, Dan Laboe, who also has picked a portfolio and share that with you.
Thanks, Shiraz. Today I'll be covering SL's portfolio, and this portfolio is full of some high-quality names that have unfortunately fallen out of favor in this market. It's rotating out of tech and into cyclical recovery stocks. So let's dive into to these holdings and take a look at where they're headed next. So SL has a very tech-focused portfolio. This thing has performed tremendously throughout 2020, but 2021 we've kind of fallen out of favor as investors rotate out of a lot of these growth names and into cyclical names. Home Depot and Johnson & Johnson continue to power higher, as well as SVB Financial Group and United Health, as well as Verizon. Always a state buoyant. Verizon trades in about a $5 range and hasn't moved out of that range for years. It continues to be just a dividend provider. So, Verizon's always a solid dividend stock to hold in your portfolio. But a lot of these other names have fallen quite a bit. Today's kind of exemplifying it. We're seeing an over 2% drop off from the NASDAQ 100. And it's being catalyzed, I think, by this downgrade from Citi for FB and Google, Alphabet. And these companies they both saw huge beats in their Q2 reports or Q1 reports. I'm sorry, and they really showed a lot of value driven into these ad sectors. And the analysts cited that they think most of this huge growth is in the rearview mirror, and we're going to see a good amount of deceleration in the second half of this year. Due to all of the pull forward demand we saw during COVID, with engagement on these sites, hitting a peak, and that I think catalyzed a bigger sell-off, broader sell-off in the tech sector. Facebook's down over 4%, Google's down almost 4.5%. You see Amazon down almost 3%, like this, and then we're seeing rotation, like I said, into these cyclical names like Johnson & Johnson up over 1%, Home Depot up over 1%, Verizon, United Health Group, and it's kind of being exemplified. And the question is, when is it time to sell out and when is it time to hold? And if you're a long-term investor, don't try to play these rotations. Just hold on to the stocks that work. Like I said, I like a lot of these stocks in this portfolio. Obviously, Apple is a staple in almost everybody's portfolio. So is Amazon. CrowdStrike, I actually really like. I almost like it today. CrowdStrike is an AI-driven cybersecurity company, and they've been discounted quite a bit since their highs. And I think that despite being a Zacks sell, I think for a long-term buy, this company is trading at a pretty equitable level considering the positioning in this space today. And we have Lam Research, a powerhouse of a chip company, and is really a necessity in this chip industry. We're seeing a chip shortage today. It's crazy that this company like this is down 6.5%, when in reality, I call this a recovery play. As more companies, come out of this pandemic with some money to spend, they're going to be spending it on chips and advancing their technology and data centers, as well as cloud computing, AI, and chips are the backbone of all this technology. Microsoft always a staple as far as tech stocks go. And Micron, we're seeing another massive fall off. Novavax, this is a stock that's really been a heavily traded one throughout the pandemic. I am a little bit apprehensive about its volatility, down to over almost 10% today, off of news that the company was going to delay its vaccine. The company hasn't produced a successful vaccine in its 34 years of operations. And they're just trying to get this out with COVID, and they're continuing to struggle to do so. NVIDIA, my favorite chip stock by far. I'm looking to buy this stock at any price around 500. Obviously, it's a pretty volatile company, but this is the chip company of the future. Its GPUs are unmatched, and it is going to be the baseline, I think, for AI. And we continue on the list here. PayPal, that's a staple another staple for fintech. And I continue to like that company. I actually think this is a GARP company. That's a new acronym, growth at a reasonable price. And I would consider buying these stocks. But like I said, if you're trying to trade this, the momentum is by far in the cyclical names and not in these tech names. These tech names are a falling knife, so to speak, and you don't want to be catching too many of these falling knives if you are trying to do short-term trades. But overall, I like the portfolio, and as a 10-year portfolio time horizon, I think you're well positioned for the future here in the Roaring 20s.
Here are a few things you can expect to see coming up. Our mobile app includes features just for Zacks Ultimate members. In addition to having access to real-time pricing data from BATS, you can opt in to receive trade alert notifications and service updates for each portfolio you follow. Plus, Be sure to check out the latest version of the 7 best stocks for the next 30 days weekly report, where Zacks experts reveal 7 stocks hand-picked for immediate profit potential, posted on the Zacks Ultimate homepage. And the next Zacks Ultimate Strategy session will be posted in early June, so start thinking now of submissions for the Zacks Mailbag and Portfolio Makeover segments.
All right, John Black, Chief Equity Strategist of Zacks. I like Alcoa this month, ticker AA. It's booming with the commodities. One story I want to pick up for you is why commodities are on a longer run than you might have thought because of the clean tech and climate change. Basically, I want to point out to you that commodities are a clean play because Alcoa is developing cleaner ways of making aluminum than the Chinese can. This happened before with coal. They shut their coal plants because they were too dirty and started importing coal. The same thing's happening with aluminum now. Particularly last Friday, we learned about this. And so Alcoa has already been doing some good the month I put it up for large cap trader, and I'm still bullish. But let's talk Alcoa. All right, Zacks price and consensus chart on Alcoa tells the story. Zacks #1 rank. Value score of A. That's critical. Value score of A. This thing is nowhere near done. Growth score of B, and look at the consensus price charts for 2021 and 2022, telling you this stock can get back into the 50s, which, by the way, was where it was in 2018, which is the other incredibly good story for you as an investor, is you have a previous high that this thing can run for all 60, 70% from here. So this is a great chart to show you the value, and they're going to keep beating. You've seen 5 beats in a row here. This is a great stock. So metal industry, number 29, average of the last 4 profit surprises plus 57%. Last one, 65%. And there's that forward P of 9. Unbelievably good stock. Here's the story I want to point out to you. The Biden infrastructure bill increasing aluminum prices, trade tension with China are the bull cases. This B. Riley guy put it together for you. If China pursues carbon emissions aggressively, which, by the way, Friday they did, this stock could be a potential multi-year tailwind because of the Chinese story, and we saw that last Friday. So you got to like Alcoa. It's got tons of possibilities here, and it's not overbought. So that's my story this time around, Alcoa.
Hey everybody, Dave Bartosiak here, and I've got a top stock pick of the month for you. It's in a industry that has really been rocking and rolling as of late, lumber. I'm talking about Zacks rank #1 strong buy stock, Boise Cascade, ticker BCC. The building products wood industry ranks in the top 8% of our Zacks industry rank. So it's not just Boise Cascade, but it's other stocks within the industry that are all doing very well in the eyes of our Zacks rank. Earnings moving in the right direction, at least estimates moving in the right direction. It is a Zacks rank #1 strong buy, again with that ticker BCC. Several stocks in the industry have that wonderful Zacks rank right now. There's been a series of big earnings beats over the course of the last quarters. Just going back the last 3, you have a 50% surprise recently, which has helped the stock move to the upside very nicely. You had a 60% beat the quarter before that, and then a 73% beat the quarter before that. So really solid earnings beats, one after another, and a stock that's a Zacks rank #1 strong buy. That's a good thing. That means you have momentum, not just in the stock price, but also in the earnings, which is something we like to look for. My last part here, something to touch on, is just lumber prices have quadrupled since last year. Something that you're seeing as a result of some of the supply shocks to the system, but also this is a demand side where there's people, new homes being built, people are remodeling their existing homes. There's just huge demand for lumber right now. And the lumber mills, it's not like they can just flip a switch and instantly create a new lumber mill and try and meet that demand. They learned their lesson from the last boom bust cycle. So this is going to take a little bit for this to work out. And in the meantime, this is what you have. Now, the last slide I want to show you is the price consensus and EPS surprise chart here for Boise Cascade. And you can see pretty dramatic move. These dotted lines multicolored represent the evolution of our Zacks consensus estimates over time, and you can see those estimates pushing to the upside for 2019, 2020, 2021. Now, remember, I said this lumber price situation may be temporary, so look at the 2022 earnings estimates. They're much lower than we are for 2021, so that's something to keep in mind moving forward, but I think this momentum play right here is rocking and rolling in the short term. So a ton of momentum in this name, not just on the earnings side, but in the price side. But keep an eye out over the very long term as those estimates are slated to come back in a little bit. But for right now, enjoy it. Zacks rank number 1, strong buy, Boise Cascade, ticker BCC.